Thank you for joining Investing City. I hope you're having a great day. But today we're just going to backtrack a little bit from our more advanced stuff, and we're going to make sure everybody's in the same level playing field. So today we're going to talk about some of the basics. What's a stock? What's a stock market? Why do stocks go up and down? What makes them actually go up and down? And how do you make money in the stock market? And so these are some fundamental questions, but they're extremely important to answer before you can start analyzing companies and doing all that good stuff. So let's really just start it off. So, what is a stock? So, in the simplest form, you can think of a stock as a vehicle in which you can buy a business. So, vehicle meaning just the form in which you can buy it. So, let's take in a little example. So I'm sure you know the company Google. So here is Google in its purest form, and here's Google's headquarters where all the employees in Google work. But then what is Google's stock? So Alphabet, just to clarify, Alphabet is Google. It's just the parent company that trades on the stock market. But we'll get into that later. So we have Google as the product, the thing that we're familiar with, Google as the location, the physical location where it is, and then Google stock. And so how do these things line up? So the stock is just, like I said, the medium of exchange in which you can buy into Google. So essentially, if you own one share, if you paid almost $1,200 for one share of Google, so right here, this little 5-letter phrase, that is called a ticker. This NASDAQ, that is an index, but we'll go on to that a little bit later. So Google trades under the NASDAQ index with the ticker GOOGL. So if you wanted to buy Google, what you do is open up a brokerage account, whether that be with Robinhood, TD Ameritrade. There's a bunch of different brokerage accounts. You'd open that up, put some information in, and then you would search for the buy option and just type in this ticker, GOOGL, or you could just type in the name of the company. So we have Google in its purest product form, where the employees work, and then the stock. So the stock is how investors invest in Google. Google, when they wanted to become public, so there's also something called private and public for a company. When you come public, you go through an IPO process, and you basically say to investors, I want you to give me money, and then I will give you stock. And so it will be this mutually beneficial relationship where if this company continues to do well, then your stock will hopefully go up. So it's pretty much as simple as that. More people sign on to Google, more advertising revenues, the better the employees do, the more productive they are. Generally, we hope as investors the stock will go up. And so you can see this is the stock price of the past 5 days. This is over the past month. This is 1 year, 5 years, and then max. So if you had bought one share of Google on August 20th of 2004 and you held that all the way until today, you would made 21 times your money. So 50 times 21 is a lot. I think that's about 1,000. So you'd have $1,000 if you just put in 50 in 2004. So that's essentially the hope as investors, that we can make those sorts of returns over time. But it takes patience, and it takes analysis, and all those things that we've touched on in previous videos. But basically, that is what a stock is. And so, what is the stock market? Good question. So the stock market is basically the collection of businesses that are public. So if your grandpa or your uncle owns a business down the street, maybe a liquor store, maybe something really small business like that, it's probably not going to be public, because public companies are usually have to be over $100 million in revenue. All these things that people like you and me need to see the validity in the company before we're going to put our hard-earned money into it. And so public, you have to get investment bankers. It's a whole deal. So every business that you see is probably not public, but the businesses that we're familiar with, like Apple, Google, Facebook, Amazon, Netflix, all these companies are public because they're huge companies and they need all of the excess money from investors in order to expand their business operations. And so we can go into a separate video on the difference between public and private, but right now we're going to just look over the general stock market. So you've probably seen little phrases like these if you've signed up onto Yahoo Finance or something like that. You see the Dow, the NASDAQ, as we briefly touched on, and the S&P. And then you see Apple and all these numbers, and you're probably thinking like, what the heck? What are all these numbers? I have no idea what's going on. And so these are the top 3 market indexes: the Dow Jones, the NASDAQ, and the S&P. So the Dow Jones is made up of 30 companies, usually blue chip type of companies. And blue chip, all that means is like very sturdy, what people call safe companies, like IBM, just the classic huge companies. NASDAQ is more tech focused, and S&P is 500 companies that make up the general market. If you hear somebody talk about the market, they're usually talking about the S&P. And so these numbers, 0.18%, negative 0.26%, and negative 0.1%, that is the percent change in this index. So the Dow went up a little bit. That means if you owned some Dow, it would have gone just up 0.18%, meaning if you owned $100 of that, you would have made 1%, like 18 cents. And so Apple, these are the price of the stock, and then this is the percent that it changed. And so that's just a primer on the stock market. Stock market is made up of stocks, unsurprisingly, and stocks are just a way that we can buy into the best businesses that we can hope to hold for the long term. And so what actually makes a stock go up and down? Like, why did this go up and why did this go down? And so it actually all comes down to supply and demand. So if more people want to buy a stock than people want to sell it, then the stock generally goes up because there's more demand than supply. However, just the same on the downside, if more people want to sell it than buy it, then the stock will generally go down. And why is that? So let's look at kind of the fundamental reason. So actually, stocks are traded electronically mostly these days, but if you can picture it, the computers are doing really the same thing as what used to go on the trading floor in New York Stock Exchange. So people would basically just call their broker and say, I want 100 shares of Apple, get it the best price you can. And the broker would go run down to the person who's making the trade and wave a piece of paper in their face and say, like, I want this for my client. However, if somebody wasn't selling, then he would basically have to increase his bid. And so if that person wouldn't want to sell it, they would just want to hold on to it and have to keep increasing the bid. So that's essentially the same thing that happens today. If there's more demand than the supply, people don't want to sell it, then he's going to have to keep increasing the bid before somebody actually sells their shares and gets a better price that they want, that they think is worth it. And so that's essentially the same thing that's happening on a kind of micro scale, because now we have computers and it's all executed kind of automatically, but that's the same thing. It's all about the supply and demand. So now onto the question that we all want to know: how do we actually make money in the stock market? And so if we go back to Google stock, how do we buy in 2004 and how do we hold all the way through, and how do we know the difference between should we buy Google, should we buy Amazon, should we buy a company that I saw that my uncle decided he recommended me to buy? How do we know all these things? And so just one kind of mental model I want you to keep in mind is you want to buy the very best companies in the world and then hold on to them. Because eventually these companies usually keep winning. Winners keep winning. Google, Facebook, Amazon, all have been incredible stocks because they're becoming more integral into our lives. They're becoming more functional, and they're just straight up making money because they're providing the most value. So think about the companies that provide you the most value, and then start doing a little bit of research, which we can touch on in the rest of the videos. But that's kind of a primer on what is a stock, and what is the stock market, why do stocks go up and down, and how do you make money in the stock market. I hope some of that helped, but just thanks for watching. Appreciate you.